All right, if you're joining us, you know what time it is. Time for our structural briefing on the digital asset ecosystem. And look, Bitcoin is sitting pretty much right where we'd expect. It's locked in that tight consolidation range, between $90,000 and $92,000. So it feels pretty tranquil on the surface, right? But if you actually dig into this source material we've gathered, well, the activity underneath suggests a radical sort of two-speed market is forming.
It's a real inflection point. I mean, the market is transitioning. It's moving from being this, speculative frontier asset to a globally integrated financial component. But that transition it's not smooth.
Okay, let's unpack this. Our mission today is to really define that central tension. You have institutional capital pouring in, building what you could call sovereign-grade infrastructure. But at the same time, the operational and technical frictions, the very Web3 elements that make this space unique, they're spiking. We're calling this the maturity paradox.
That's the perfect way to frame it. The price might be idling for a moment, but the really critical developments are all centered around the rapid financialization of liability and collateral frameworks.
Okay, that sounds like a lot of jargon.
It is. It is. But let's ground that. It just means we are now using crypto as simple, high-utility bank collateral.
Yeah.
And we're doing it in the world's most regulated markets. This is a watershed moment for infrastructure.
Let's start right there. Here in the U.S., with the Commodity Futures Trading Commission, the CFTC, they just launched a pilot program that feels like a massive step towards that integration. So what's the core rule change here?
The CFTC has officially authorized the use of Bitcoin, Ethereum, and USDC as non-cash margin.
Non-cash margin.
Right, which is just another word for collateral within regulated derivatives markets. Now, for the sophisticated listener, you'll know this is enormous because it completely changes the relationship institutions have with these assets.
Okay, let's simplify that technical language immediately. So non-cash margin means collateral that isn't cash. But what is the practical significance for, say, a major bank or a big trading firm?
Well, it fundamentally revolutionizes capital efficiency. It gets rid of something called capital drag. Think about it. An institution might be holding $1 billion in Bitcoin, but they also want to manage derivatives exposure. Before this, they had to either sell the Bitcoin into fiat, which means fees and tax events, or keep this huge idle cash reserve for margin calls. Now they don't have to choose. They can employ capital and use the digital asset itself as insurance.
So their Bitcoin can maintain its market exposure while simultaneously performing a utility function as collateral. That's the efficiency part. But let's talk about the risk mitigation angle you flagged in the material.
Yes. This is what's fascinating here. It's the mitigating effect on systemic risk. Crypto assets, as we know, they settle 24/7.
Right. No weekends.
No weekends. And in previous market cycles, that weekend volatility was deadly. Firms couldn't wire fiat until Monday morning to meet margin calls, which led to forced liquidations and those cascading flash crashes we all remember. Using BTC or USDC now allows for real-time 247 margin management. And that should, at least in theory, dampen the severity of those weekend events.
That makes this pilot program, which is currently restricted to just 3 months, a really crucial testing ground. And it also implicitly validates USDC as systemic collateral, right? It puts stablecoins firmly in the realm of global finance.
Absolutely. The direction of travel is unmistakable.
Okay, speaking of asset utility, let's move over to Strategy Inc., formerly MicroStrategy. They just made another huge acquisition, cementing their status as the corporate treasury benchmark.
A huge one. They acquired an additional 10,624 Bitcoin for just under $963 million. That averages out to about $90,650 per coin. And this brings their total holdings to 660,624 BTC. The scale is just, it's hard to comprehend.
And the funding mechanism for this, the at-the-market or ATM equity offering, this is a major focus in our sources. They're essentially selling MSTR shares, which trade at a huge premium to the underlying Bitcoin value to then buy Bitcoin at the spot price. They even call the accretive value BTC yield.
I mean, they're cashing out the market's hype premium on their stock to buy the hard asset at its spot price. It's pure arbitrage. And while it's impressive financial engineering, you have to ask, what's the long-term risk of selling premium-priced equity to buy a spot asset? It relies on that sustained market enthusiasm for the MFTR stock.
That's the strategic vulnerability. But the move they just made to de-risk their existing stack, that seems far more significant for their long-term survival.
That's the real sign of maturity. Strategy Inc. announced they're establishing a $1.44 billion USD cash reserve. This fiat liquidity buffer is designed to cover roughly 24 months of their total debt and dividend obligations.
And why is this $1.44 billion fiat reserve the most strategic part of their announcement?
Because it eliminates the primary fear of the skeptics. It eliminates capitulation risk.
Forced selling.
Exactly, forced selling. In a deep crypto winter, a leveraged company would typically face margin calls or debt payments that would force them to liquidate their BTC at depressed prices. That creates a supply wave and pushes the market down further. By ring-fencing 2 years' worth of liabilities in fiat, they are guaranteeing they can hold their Bitcoin position through any volatility spike or bear market. It's a sophisticated policy focused on endurance.
So Strategy Inc. is showing that institutional maturity in the West. But let's see where the rest of the global institutional capital is flowing, because that picture is shifting, and it's shifting fast, particularly to the east.
We're definitely tracking a major geopolitical realignment.
The Abu Dhabi Global Market, the ADGM, has secured massive, coordinated regulatory approvals from some key players: Binance, Tether, and Circle, all at once.
This simultaneous embrace by the UAE is very calculated. It's designed to position them as a global hub. So Tether's USDT was recognized as an accepted fiat reference token. And critically, the ADGM authorized USDT for use across 9 distinct blockchain networks, including emerging ones like Aptos and TON. This deepens the liquidity pool way beyond just the main Ethereum network.
And Circle, which issues USDC, they received a full financial services permission license, the FSP. What strategic advantage does that give ADGM?
The FSP lets Circle operate as a comprehensive money services provider, so issuance, custody settlement,
Right.
all directly integrated with traditional banking partners inside that jurisdiction. So when you put Binance, the exchange,
Right.
and Tether and Circle, the liquidity, and the regulated custodians all inside that ADGM perimeter, you create this regulatory walled garden of liquidity. It's designed to attract that risk-averse institutional capital that demands clarity and doesn't want jurisdictional friction. That's why people are starting to call the region the Delaware of digital assets.
Speaking of regulated gateways, let's look further east to Hong Kong and the massive Hashkey IPO.
Right. Hashkey Holdings, they operate Hong Kong's largest licensed exchange, and they're pursuing an IPO. They're looking to raise up to $215 million, targeting a valuation near $2.5 billion. This isn't just a simple capital raise, though.
No, their capital deployment plan is very strategic. It looks heavily focused on building a new kind of digital railroad.
Precisely. They are allocating 40% of the capital for tech infrastructure, specifically for developing the Hashkey chain, which is an Ethereum Layer 2 network optimized for real-world assets, or RWAs, and institutional settlement. Another 40% is for expansion, with only about 20% dedicated to risk management and compliance.
And what's the geopolitical importance of Hashkey's success here?
It validates Hong Kong's whole pro-crypto financial policy and its strategic relationship with the mainland. I mean, while China maintains its ban, Hashkey serves as the compliant, regulated interface for latent Chinese institutional capital. So this IPO, it basically establishes the blueprint for how regulated exposure is going to occur in the Greater China region.
So we've seen the U.S. institutionalize Bitcoin as collateral, the Middle East cement itself as a stablecoin hub, and Hong Kong open the capital gateway to Asia. So how is capital reacting to all this structural good news?
Well, the flow data from the U.S. Spot ETFs, it gives us a really clear signal about investor psychology right now.
Okay, run us through those flows.
We saw net outflows of approximately $60.5 million from U.S. Spot Bitcoin ETFs. This suggests some profit-taking after the recent rally. But here's the key part. Simultaneously, we saw strong net inflows into other products. $35.5 million into Ethereum Spot ETFs and $38 million into XRP Spot ETFs.
So investors are selling a bit of their most foundational asset, Bitcoin. But they aren't leaving the sector. They're immediately rotating into higher beta altcoins. What's your interpretation of that risk-on rotation?
It signals investor comfort with their core BTC allocation. They see Bitcoin cemented as the reserve asset, and now they're seeking alpha further out on the risk curve. The strong XRP inflows specifically suggest renewed institutional confidence after that asset's recent regulatory clarity. The foundational layer feels secure, so they think it's time to gamble on the faster growth assets.
And now let's look at the fascinating strategy being used by Tether. They are investing heavily, but not in crypto.
Tether is increasingly behaving like a kind of decentralized sovereign wealth fund. It's really interesting. They generate these substantial profits from the interest on their stablecoin reserves, and now they're using that surplus to diversify into hard tech. Their latest move was an $81 million investment in a company called Generative Bionics.
Which is an Italian startup focused on humanoid robotics for industrial applications. So they're creating new productive revenue streams that are completely uncorrelated with the crypto market cycle. They're calling it physical AI.
Exactly. This strengthens the backing of USDT by creating a diversified portfolio of tangible, productive assets. They're reducing their reliance on centralized financial or big tech incumbents, and they're positioning themselves as a self-sustaining entity in the process. The massive philosophical shift for a stablecoin issuer.
And on the protocol side, we have Farcaster, the decentralized social media platform, making a major pivot away from social content and towards commerce.
Farcaster is shifting its strategy from social first to wallet first. They're embracing the super app thesis, like Asia's WeChat. I think they realize that competing for pure user attention against the Web2 giants is incredibly difficult. So their core belief now seems to be that the killer application for crypto is commerce and seamless transactional capability, not just decentralized content feeds.
Integrating payments and the whole degen economy directly into the social feed.
Right. It's about focusing on capturing high-value transactional volume rather than just battling for low-value user engagement metrics.
And finally, Cardano's Midnight Protocol, which is launching its Night HT token, is aiming to solve one of the biggest paradoxes for institutional adoption.
It addresses the compliance conundrum in DeFi. Institutions need privacy, but traditional privacy protocols attract immense regulatory scrutiny because they allow for, total obfuscation. Midnight uses zero-knowledge, or ZK, proofs to enable selective disclosure. This means institutions can transact privately on a public ledger, but they still retain the ability to selectively prove compliance, like the source of funds to auditors or regulators when they're required to.
That brings us squarely back to our maturity paradox. We've analyzed all this sovereign-grade infrastructure, CFTC authorization, ADGM licenses, multi-billion-dollar fiat reserves, but the underlying industry remains deeply fragile at the periphery.
The recurring operational and technical frictions are absolutely the dark side of this whole maturation process.
So give us a few examples of those persistent security incidents from the source material.
Well, the Yearn Finance exploit is a stark reminder. This is a highly respected blue-chip DeFi protocol, and it suffered a $9 million loss due to an unchecked arithmetic bug in the smart contract code.
And for those unfamiliar, an unchecked arithmetic bug sounds minor, but in these immutable smart contracts, it means a simple mathematical oversight can lead to a multi-million-dollar disaster. And this is in code that has been audited multiple times. It just highlights that persistent smart contract risk.
And it's not just the core contracts. The sources also mentioned the React2 shell vulnerability. This is an ongoing threat of exploits that target the peripheral Web2 front ends. So even as the core blockchain infrastructure hardens, the points of access, the interfaces that you interact with daily, they remain weak and vulnerable to attack.
We also need to look at the network trade-offs that are required for scalability, specifically the drama happening in the Solana validator ecosystem.
Yeah, the data showed a massive drop in active Solana validators. It contracted from about 2,500 down to roughly 800. That's a decline of nearly 68%.
Wow.
A huge headline-grabbing number.
Wait, a 68% drop? I mean, if a traditional system lost 68% of its capacity, that would be a full-blown crisis. How are the proponents selling that as good news?
Okay, this gets to a fundamental philosophical debate in Web3. Proponents, specifically the Solana Foundation, argue this is a deliberate structural consolidation. They say they're removing underperforming or extractive nodes. They claim the remaining 800 are high-performance, professional operators, which improves network stability and latency. They are prioritizing efficiency.
So they're sacrificing the ethos of raw decentralization for sheer speed and performance.
That's the core tension. The critics view this contraction as explicitly degrading censorship resistance. They argue a smaller set of nodes is just easier to influence or attack. It highlights that difficult trade-off that high-performance blockchains must constantly manage: decentralization versus hardware requirements and scalability.
And finally, let's cover Robinhood's strategic move, which shows that established players are now seeking growth outside of the saturated Western markets.
Robinhood just acquired 2 licensed entities in Indonesia, and their rationale is simple. They're pivoting toward high-growth emerging markets. Indonesia has a population of over 270 million, a young median age, and critically, it already has 17 million crypto traders. That's an established, engaged user base.
And by acquiring licensed entities, they bypass those lengthy, complex licensing processes. They get immediate compliant access to that massive market. It's a buy versus build strategy for global expansion.
And as part of a wider trend, you're seeing Western fintech firms realizing the next generation of growth won't come from the US or Europe. It's going to come from these highly active emerging markets in Asia and Latin America.
This has been a deep dive that really paints that bifurcation of the market so clearly. Let's synthesize the takeaways. The maturity paradox is really the story of the day. You have sovereign-grade, multi-billion-dollar infrastructure being built, CFTC, ADGM, Strategy Inc.'s huge fiat reserve to handle institutional capital. But at the same time, Web3 security and the trade-offs for scalability remain a persistent source of vulnerability.
The signal is unmistakable for you. Bitcoin is being cemented as a reserve asset. It's moving past that Wild West phase. Capital is rotating into high-utility, regulated altcoins and infrastructure plays. And geographically, the market's focus is shifting eastward toward regulated hubs in Abu Dhabi and Hong Kong.
So what does this all mean for the long game?
Well, the institutional adoption we've been talking about, especially the move by the CFTC to accept crypto as collateral, it means that major financial institutions now have a vested financial interest in asset price stability to preserve their capital efficiency. And this begs a crucial question for you to consider moving forward. Does the relentless pursuit of institutional utility fundamentally alter Bitcoin's historical volatility profile? And if so, what does that stability mean for its function as a disruptive force against legacy finance?